Tesla and most other EVs are purchased with financing, and lower rates would help make those vehicles more affordable. But our next guest says the company should brace for a potential massive headwind, which is another Trump presidency, possibly. As the former president has implied, he could end the EV tax credits under the Inflation Reduction Act. Tesla has been the biggest beneficiary so far in terms of EV tax credits now. So joining us for more is Colin Langan, the automotive and mobility analyst over at Wells Fargo. Colin, take us through why this is such an issue, because, frankly, Tesla shares have had a nice, decent bounce off some of the lows that we saw earlier this summer.
Yeah, I think there's a bit of a misperception since Elon has been supportive of Trump that this, somehow a Trump presidency would be good for Tesla. If you really step back, we estimated in our report today that there's about, $12 billion of IRA funding that's been given to the market. And about, close to, 7 of that has been Tesla related between their buyers who get up to 7,500 credits when they buy a vehicle, as well as production tax credits, which could be well over $3,000 per vehicle. So we're talking about $10,000 per car in the U.S. If that gets removed, it's quite a material headwind for Tesla. And that's really the key point in our note today.
OK, so if that is the case, there is a reason why you have a sell rating on that stock and a $120 price target. It's largely been tough to be a bear on Tesla, even with some of the big drawdowns that we've seen. How exactly does this then play out? It's not a straight line, but why exactly is the fair value that you've assessed down where you have it right now?
Yeah, I mean, Tesla never really ever moves in a straight line. I think when we look at it, there's probably going to be some bumps over the next month. I think particularly the robo-taxi day, typically you get hype into that. But also what we find is that historically there's a lot of hype into those events, and then the stock fades off after. The fundamental reality here is the auto business has been under pressure. If you look at the first half of the year, we have negative pricing and negative volumes. So you have a company that has negative elasticity at this point. So there's a big concern that I have about where volumes, where pricing's going, and what that means for margins. And I think, ultimately those fundamentals should rule, and the stock should be under pressure, and that's really the driver of our underweight rating.
So add to this the competition. Can you just talk to where you think that's going to be in a year or two with so many companies coming in with lower prices? Yes, the Chinese will have tariffs on BYD, but compared to the rest, where do you see that landscape?
Well, we're already seeing Tesla has been losing EV market share to improve competition from the traditional companies. That said, the traditional companies are struggling with profits as well. And our report today does talk about, a pocket here that, Trump actually could be negative for the traditional players as well in the midterm. There's an expectation that if he comes in, we're going to reduce the fuel economy targets. But that probably is a 2028 type event. It took about 3 years last time for him to reverse fuel economy standards. And so if he wins this time, I think there's a bullishness that he might do that. But there's also this concern that we highlight in the report today is that the IRA credits, which are, for many vehicles, $10,000 a car between the production tax credit and the consumer credit, those could go away faster. So there could be between 26, 27, a period where automakers have no support and yet they have, tough standards. So we're going to see better models, more competition. But, I think for the whole industry, and we're underweight all the Detroit 3, there's a lot of challenges, electric vehicles being one of the biggest.
All right. Tesla shares down about 12% year to date with a 78 forward multiple. Colin Langan, thank you very much. We'll see you soon.